Hello everyone and welcome back to the Property Podcast. I'm Rob B and joined of course by Rob D. A few weeks ago we talked about alternative finance, but this week we're going to look at a growing industry that everyone seems to be talking about, but not a lot of people know much about it. It's financing through limited companies.
Yes, thank you for joining us for episode 178 of the Property Podcast. This should be a popular one because more and more people are buying property within a limited company. We'll go into the reasons for that later. When you need financing for that, there are certain things you need to know. If you know them, it can go very well. If you don't know them, you might end up getting tripped up, slowed down, disappointed, any number of things. So, with a little bit of help this week, we're going to tell you what those things are so you can have a nice, easy time of it. Also, we've got a great resource of the week and a news story. You can probably guess what it is if you've been paying any kind of attention. But first, Rob, we were at meetups last night. How was it for you?
We were. It was brilliant. I got there a little bit late because of some work commitments, but when I did, it was very, very welcoming. The King's Cross meetup is normally a busy one, and I've been a couple of times before. They were downstairs this time, which was great. As always, though, wherever you go, everyone was very warm, very welcoming. And you always get good ideas as well, because the podcast, obviously, is one way. You know, we're talking at people and they can't talk back. You can do, but you probably just look a bit silly. But at the meetups, people can grab you for a few moments, give you some feedback, give you some ideas. So I always take away things from the meetups, which are really, really good. I haven't decided where I'm going next month yet, but that's the beauty of it. There's so many, you can decide. What about you, Rob? How was Leicester?
Leicester was great. Mark, who's the leader there, he used to do a meetup in between Nottingham and Derby. There's now a separate Nottingham meetup, which had its first one last night. Mark has now moved his meetup to Leicester, and really, really nice venue. Really great group of people. I think there are about 15 people there. It was really nice to meet people like Mandeep and Stuart, who I'd spoken to online or on the phone before, and actually got to meet them in person, which was great, and meet lots of new people as well who are doing everything from rent to flipping to HMOs to buying and holding. There was a real good mix of different kind of experience and different activities, and as you'd expect at a Property Hub meetup, just a thoroughly nice group of people. So I had a really good time.
So, news story of the week. Yes, it probably won't come as a shock, but it's the interest rate chop. If you somehow have missed it, interest rates were 0.5 and the Bank of England have taken it down to 0.25. What does that mean? Well, it may mean cheaper mortgages moving forward. If you're on a tracker, it certainly does mean cheaper mortgages moving forward. Or if you are on the standard variable rates, it possibly means cheaper mortgages as well. I know a proportion of my mortgages have gone down, so that's good news. But also at the same time, the Bank of England have made two more announcements that they're buying bonds, and a lot, and they're starting quantitative easing again, and a lot. Now, not going to go into too much detail on the quantitative easing or the purchase of bonds, because we're going to do something on that in next week's podcast. Won't go into too much detail now. At the end of this episode, we'll talk about what's coming up, but it should be, well, at least it will be to Rob and I, really interesting because we're geeks. But hopefully we can make economics next week really interesting and show you how it'll impact you. But as I say, more on that at the end of this episode because, Rob, we've got a very good episode coming up.
Yes, we have. So we're going to be talking about financing for limited companies, what you need to know. In order to establish what you need to know, we had our own ideas, but we thought, well, the best thing to do is to ask a mortgage broker who has done probably hundreds of applications for this kind of financing and has seen all the things that can go right, all the things that can go wrong, all the different products that are available and how that's changed. And so we asked our friend Dave Cookson from TC Financial Solutions. He is a contributor to the magazine. He's got a great article in there every quarter. And he was kind enough to help us out with putting this episode together. So thank you very much to Dave. Lots of really useful tips in here. So if you are interested in going down the limited company route and you're going to need a mortgage, as most of us do, this is going to be a very valuable episode for you. Let's start though, by putting this in context a little bit, Rob, but by talking about why we're choosing now to talk about this topic when we've ignored it for about 3.5 years.
Yeah, why not? Let's start there. Okay, so Why are we talking about it? Well, because of the government. And why? Well, the government, as you are probably aware, again, and if you don't know this bit, you really have been living in a cave. The government has been setting us up in the future for changes, tax changes. And that will mean that if you're buying through your own name, potentially, not in all cases, but potentially you may be worse off. And because of that, people have looked for alternative ways of buying property. Now, one of the ways that people are going to buy property moving forward is through limited companies. Now, Rob and I have talked about this subject in quite a lot of depth, not the lending, but the company side of things and buying through limited companies. So what we'll do is we'll link all those episodes in the show notes so you can go to one place and find them all. If you go to thepropertyhub.net/company lending, that's thepropertyhub.net/company lending, we'll direct you to all those episodes, which will give you more information on whether it's right or wrong for you. But it certainly is now a good thing for many people. You'll need to get a mortgage product specifically for a company. So that's another reason why we're talking about it. You can't just go and get a normal mortgage if you're buying through a company. You need to get a specific mortgage product for limited companies. And Rob, the process is the same. I've been through it myself. It's a little drawn out, but there are differences, and that's important that people are aware of them.
Yeah, it is. If you're going through this for the first time, it's not like it's some entirely different experience. The whole process will be very familiar. The bulk of what you're required to do and to prove and the things they'll look at are the same. But there are some small but important details. Just like with any kind of lending or any kind of paperwork, really, there is these little things that can come out of nowhere and trip you up if you're not aware of them beforehand. If you are aware, you can avoid them very easily. And also, when it comes to where to look for your funding options, like you said earlier, if you're assuming that you're going to have all the same products available to you, then you're going to get a bit of a nasty shock. But we're going to talk a little bit about what lenders are available and how to find out and all that kind of thing as well. So let's then get into some of those things that you need to be aware of.
So as we've already alluded to, it's a sector in its infancy. So you cannot expect the same amount of products and the same flexibility of products that you can in buying in your own name. You are still pretty limited. I'm sorry. And that means that you can't just decide to buy through a company and I always expect to get lending. There are certain criteria, certain things you as an individual needs to meet, and certain criteria your property needs to meet for you to be able to get lending. So remember that it's not a guarantee just because you want it and you can get mortgages through your own name that you're necessarily going to be able to get them through a company name. We'll talk about the future of company lending in a bit, but it's important just to make everybody aware of where we are now. It's not the same as normal financing a buy-to-let through your own name.
No, and an example of that is if you get lending through companies like the Mortgage Works, who tend to be the most amenable to certain types of borrower, they don't do limited company lending. So if you're restricted to a few lenders like that because of other circumstances, then it could make getting a limited company mortgage quite tricky. But we'll get into that more in a minute. First, one of those little details that I mentioned that can trip you up is the need for the company to have a specific SIC code. That's SIC. I don't know what it stands for, but what it is it's a classification code that every company has for HMRC that describes what it is that the company does. And most lenders require the company to have one of three specific SIC codes that refer to property-related activity. What that's basically saying is that lenders want the company to be set up specifically for buying or trading in property. So if you've already got a company, a trading company that you use, that's your business, or you're a contractor or whatever, you might have a company already. But for the majority of lenders, they're not going to want you to buy property within that company that you've already got that's also conducting other activities. They would rather you set up a brand new company with one of these specific codes, and they want to see that company used as effectively an SPV, a special purpose vehicle for owning the property, which seems a little bit counterintuitive, and I've spoken to a few people about this because they think, I've got a company, I'm a contractor, I've been doing it for 5 years, so I've got all these accounts. That's really good. The company's got a trading history, which will be attractive to lenders, but actually they don't want to see that. They want almost like a blank slate. or they at least want a company that is specifically set up for the purpose of property. So really easy to do. Registering a company is exceptionally easy. You can do it online in about 15 minutes and it costs you about £20. That part is extremely easy, but when you do, they'll want it to have one of these specific codes. So just one of those little details, one of those things to be aware of. If you don't have a company set up, then you'll need to set one up. And even if you do have a company set up, you'll need to set up a new one. So there you go.
I'm quite surprised, Rob, that you didn't know a SIC code was a standard industrial classification set up in 1937, originally in the United States, and then it was used by other countries, including the United Kingdom.
That's an embarrassing knowledge gap, isn't it?
I promise you that's not Google and Wikipedia. That I've just done quickly on my phone. Right. The other thing you need to know is that it's slow. Getting a company mortgage is painfully slow. They ask a lot of questions. They want to know a lot of detail, not just about the company, but also about yourself as an individual. Really, company mortgages, for the majority of people, are just a company mortgage in name, because the vast majority of cases, you have to back it up with your own personal assets. It's funny, it's crazy how it works, but that's just how it is. And the upshot of that is they want a lot of information. It takes a long time to go through. So, piece of advice, start talking to brokers long before you commit to buying a property. Because if the deal needs to move quickly and you're buying through a company and intend to get a mortgage, the deal might fall through. I've seen it happen. We've had people through R&P try to buy through companies and it just drag on and they've just missed the deadlines. So if you're going to do it, make sure you have all your documents ready. Bank statements, pay slips, SA302s, the accounts. Get it all together. Speak to a broker to find out what documentation they're going to need from you, what information they're going to want to present, and get it all ready to hopefully speed things up. But be aware of it. And if you are going to go down that route and the deal needs to be done quickly, just be all over it.
Next point is, as we've already alluded to, the normal requirements for you as an individual still apply. So while you need a mortgage specifically for a limited company, it's almost like the company is transparent in terms of what they're looking for, and they're looking straight through that to you, just as they always do. So they'll look at the director's income, and just like with most lenders, they'll normally want to see more than $25,000 a year in non-property income. It's just the same in that regard as regular buy-to-let. So if, like I said earlier, if you have a limited choice of normal buy-to-let products, you'll probably have an even more limited choice when it comes to companies. But if your circumstances are such that you have a very wide choice, then you'll probably have the widest possible choice of company mortgages. You don't, however, need any specific level of experience, which is another kind of misconception that I've come across. People often seem to think that you need to have properties already. You almost need to have proven property as a business before you can get a limited company mortgage, but that's not the case. Your very first property investment can be in a company with no problem whatsoever, but you would still need to be able to qualify for a buy-to-let mortgage as an individual in order to get one in a company, if you see what I mean. Another important point to note is that some lenders will only allow mortgages on a repayment basis. Dave said that's normally the high street lenders who want that, rather than your specialists like your Shawbrooks and Paragons and all the rest of it. That's, again, something you need to be aware of, because many of us are fans of using interest-only mortgages and kind of do our numbers on that basis. And so if you do want to keep doing that, that will again slightly reduce the pool of lenders available to you, unless you want to do repayment, in which case that's fine.
One of the benefits of buying through a company, and we've talked about this before in a podcast, but it's worth just to bring it up briefly and then go back to the previous episodes that we've talked about. But if you're a contractor and have a limited company, or you have a business that's set up through a limited company, you can make intercompany loans to provide the deposit. Now, it's a complex, it's complex enough that you need a podcast on it. So go to the show notes, thepropertyhub.net/company lending, and you can find out more about it there. But there are huge benefits to doing that. And the fact that you can do that to fund your deposits is a huge advantage for people who own businesses or are contractors who pay themselves through a limited company. It gives them a real advantage a tax advantage of providing themselves or their companies with the deposit they need to get lending, and the mortgage companies are comfortable with that. So a benefit there.
Yeah, very much so. We've explained this to some people on summits, and for people who are contractors or have their own business, they suddenly get very, very excited when they realise the implication of that point. So that is a real benefit. But also a note of caution is something else that you need to be aware of when you get to the stage where you've got multiple properties in the company. So if you're setting up the company and putting a property in it for the first time, no problem. But you do need to be careful when you get to the stage where you're buying multiple properties within the company. It used to be the case with lenders most of the time that they'd need a debenture over the company's assets. What that basically means is that they've got a claim over the property. So if you stop making your repayments, they can take the property. But they also want to have a claim over the assets of the company in general. So if they can't get their money back just by repossessing and selling the property, they can come after the assets of the company in general. That could cause problems, because if you then want to get a mortgage through another lender, because they're more competitive at that time, to buy a new property within that same company, the first lender often wouldn't allow it, because it then means they wouldn't be able to have sole claim over the assets of the company. Now, that is changing. The majority of lenders are now okay with having multiple different lenders within the same company. Dave gave the example of Paragon, who used to insist that you had a separate company just for lending through them, but they removed that requirement about 8 months ago. So it's that kind of knowledge that's really important, because it's the kind of thing where you can look and you can think in theory that something's going to work really well, but there could be little details like that that could actually derail the whole thing. So it is less likely to be an issue than it used to be, but still something that's worth being aware of. And it's, of course, very good news that that's changing, because you don't want to be in a situation where you have to have a separate company for each group of properties that you have with a different lender, because then it's multiple different sets of accounts and bank accounts and hassle and everything else. So again, just a little detail to be aware of.
So what does the future hold? Well, before we pass our comments, let's have a look at what Dave had to say. So his comments were very interesting. Although we've seen some recoil after Brexit, I still believe it's a growing market. I'm aware that Lloyds have put great effort into a feasibility study about BM Solutions joining the market, as they currently take up a quarter of the individual buy-to-let market, about £10 billion per annum. Then it could really shake up things. We've also seen the emergence of new lenders such as Fleet and Metro, and if corporation tax is reduced to 15%, then this market will only get bigger. What do you think, Rob?
Well, for a start, I didn't realise that BM Solutions had a quarter of the market. That's massive. But yeah, the point about corporation tax is a good one. And yeah, it is really encouraging to see new lenders coming into the market. I think it's a couple of different things. It's new lenders. And so I've spoken to a few people who approached Metro Bank and found them quite amenable. And that's good news to have more of a selection. But also some of the things that we've talked about, such as some of the requirements around it easing. So even with lenders who were there before, there aren't quite so many hoops you need to jump through or criteria that you need to meet. So I think it's hard to disagree with Dave, really. It seems very much like that's the direction things are going in. And I think you could say this is the second time in almost as many weeks that we've been right about something, and we need to fly the flag when we can, because we've been visibly wrong about so many things in the past. But we have been saying for a while that lenders like to lend, lenders follow the market. There are so many factors that are pushing investors towards companies that this was kind of always going to happen.
So let's wrap this up then. Key points. First of all, start early. Do your homework and get good advice. Company mortgages do require a bit more patience, but it could be worth it depending on your situation. But that's important. It might not be the default option. A lot of people are going in to buying through companies because they've heard people talk about it and haven't actually had their tax affairs assessed. So make sure it's right for you. And a reminder that a mortgage through your own name is better than no mortgage at all. So if you can't buy through a company, there's no point in walking away from the deal if it's a really good one. You're better off buying through your own name. So be aware of that. It might not be the most tax efficient thing for you, but it might not be as bad as you think. So be prepared to have a backup at this stage while the market's in its infancy. And of course, we have to say, Rob, a huge thank you to Dave for putting this article together. Dave from TCFS. He, as Rob mentioned at the beginning, contributes to the Property Hub magazine every quarter. He does a great job there. So thank you, Dave, for helping out with this episode too.
Yes, thank you very much to Dave. And you can find all the show notes for this at thepropertyhub.net/companylending. And an equally big thank you to our iTunes reviewer. It's episode 178. We've had an iTunes review read out on, I think, every show since probably the third week or so. We're still nowhere near to running out, thanks to very kind people like the one you're about to read out, Rob.
Yeah, it's a short one, and it comes from Freeman 3030. And he or she says, I've only recently come across this podcast. I'm on episode 7, but I love it. Very informative and easy to listen to. Keep up the great work. I wonder if Freeman will get as far as this episode, Rob, or whether we'll annoy them by episod 178.
Depends if they're from Burnley or not, or one of the other groups that we've offended along the way.
We're working through the list one by one of places to pee off. Right, okay. So that's our review. But of course, you're hanging on because you know there's some good stuff to come. Next week's episode coming up. But first, Rob, we have our resource of the week.
Yeah, and this is one that I hadn't heard of until you mentioned it earlier, but it's a replacement for a resource of the week that we had quite a while back called Lucidchart.
Yeah, Lucidchart is a great resource, and it still is. It's a way of charting out flows. So if you have to visualize a process, Lucidchart's very good. Maybe you want to create an organizational chart, Lucidchart's very good. Admittedly, it's not going to be for everyone, but if you're in business or you're a student and you need to create a chart, Lucidchart was great. Unfortunately, the cheeky scamps, they've started charging, and now you can only use 5 sheets before you have to start paying. But being the cheapskate that I am, I found a free alternative. Hooray! Draw.io. Draw.io. It's at least as good. You could argue maybe even better. It's very, very good. We'll link to it in the show notes, so don't worry about jotting that down now. Plenty in the show notes this week, which is thepropertyhub.net/company lending. Plenty in the show notes, but check that one out, because if you ever need a chart and you want an effective way of doing it, that could be a way of approaching it. I did try Google Draw for the first time, or Google Sketches. Can't remember what it's called, but it wasn't that good. But this one attaches to Google. It's an extension. It's got really good integration. So if you do use Google Drive or anything like that, it's very good.
Well, I'm pleased that I've got a new tool to play around with and waste some time with. I'm also pleased that this is, I think, the one week ever when I haven't come across as the cheapskate out of the two of us. So I'm gonna revel in this one.
Well, I thought after 178, Robin needed to share the load.
Exactly. Speaking of money, I might have an aversion to spending money, but the Bank of England certainly doesn't. We're going to be talking next week about something that I attempted to say just now, and hopefully our editor has edited it out. We're going to be talking about QE. What does that stand for, Rob?
Quantitative easing.
Damn it.
Hey, that was first time. I don't know whether you believe me. But we're going to talk about quantitative easing next week. And it could be dull, but I'm promising you we won't make it dull because it's important. We've talked about the economy before. We've done quite a few podcasts on the economy. But if you understand what's happening, then you can make moves and take action based on that education, that understanding. And quantitative easing is huge. Not the numbers involved, but the impact it can have. And not just on the short term, but on the long term. So we're going to discuss that next week. We're going to start off by looking at what it is. And then we're going to look at the impact it'll have on property. So I promise you it'll be a really, really valuable episode. I'm not sure you're looking forward to it, Rob. You're going to have to practice. Or just keep saying QE.
Yeah, I think I might do that. Okay, so that is next week. It will be a good one, I promise. To tide you over until then, loads and loads of links in the show notes this week at thepropertyhub.net/company lending. So you can go back and listen to some related episodes there. And also, of course, you can tune in to Ask Rob and Rob on Tuesday, where we're going to be talking about whatever someone wants to ask us. So we'll wait and see what that is. But for now, though, thank you for listening. Enjoy your day. We'll see you very soon.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.